Welcome to the WakeCon show, where we discuss housing economics and the economic forces shaping our communities. We're powered by Professor Lending, which is a residential mortgage broker based in Wake Forest, North Carolina. Hence, Wake and Econ together makes WakeCon. I'm Jordan Steffaniak, your mortgage professor, your licensed loan originator, and president of Professor Lending. And I'm looking forward to talking with you guys today in this masterclass on being a first-time home buyer, what to do, what to look for, how to exactly strategically set all these things up. This isn't just for first-time buyers. This is for everybody, because most people buy a couple houses in their life. They don't remember. They're never taught these sort of things. So it's important to be educated so you can be empowered to make the best decision for you, your family, and your future. That's why I'm here, to give you this information so that you can make the best decision for you. So if you tuned in earlier, I've got Masterclass on when to buy. Should you buy now? Should you wait? Hint, you should buy now. Don't wait. Number 2, what do lenders look for? How do you qualify for a mortgage? And then here, our module number 3 of 5 is, how much money do I really need to buy a house? By the end of this video, you're going to know the real minimum down payment by loan type. You're going to know what your closing costs actually are and how to reduce them. And you're going to see 3 real buyer scenarios side by side. Most buyers are going to overestimate how much cash they need by 2 to 3 times. The number's almost always lower than you think, but there's also confusion. Down payment versus closing costs. So we're going to talk through all that so you have a clear sense for what it looks like and how much you actually need to buy a house. So let's tackle the down payment, shall we? Down payment by loan type. Conventional, 3% minimum down payment for first-time home buyers. It's usually best for stronger credit, but sometimes if you have a lower credit, it can still be the right solution for you. And it may be the only solution for you, depending on your background, your experience, and sort of your overall credit profile. FHA, 3.5% down, minimum down. Best often for lower credit, but it's also the best solution, depending on the scenario, for strong credit profiles. There are lots of reasons this may be the case. Maybe you're buying a new construction house and they're giving you a $30,000 credit, and you only have 5% to put down. FHA is going to be a great option. Why? Because it allows up to 6% of the purchase price to be seller credit. Where conventional, if you do less than 10% down, you can only use 3%. You don't want to forfeit that money. You want to use it and invest it. So FHA may be the right option in those scenarios. USDA, 0%, eligible for rural areas only. So if you live in a city, downtown, it's probably not USDA eligible. VA, 0% down. This is only for veterans, but it is the best loan in the mortgage market, though conventional is pretty close. People don't realize that. Conventional is awesome. So let's talk about the down payment. Again, grants are also available for buyers. So it's not just the down payment. There are actually grants that can help you. There are lender-sponsored grants where they may be forgivable grants. They may be second liens. They may be up to 5% be provided. There are also government-sponsored programs. These typically have strict qualifications, and they typically run out of money pretty quickly, but there are also options. And then there are private sponsored programs that are usually very strict qualifications. If you find a privately sponsored home, like down payment assistance program, usually it's like, you got to come to the club meetings every week. You got to come do these things. And it's like, whoa, didn't realize there were that many strings attached. Let's just do an example. I'm here in North Carolina myself, so I'm going to use one that people come up with all the time. To me, the North Carolina First Home Advantage down payment. It's a nice tool. Gives you up to $15,000 assistance with eligible lenders for first-time buyers. It is a 0% deferred second mortgage, which is forgiven 20% per year at the end of year 15. You've got to meet the income requirements. Your home has to meet the sales price limit, be within the sales price limit, and you have to have a 640 or higher credit score. So that may kill the deal for you. If you don't have the credit score, maybe a lender-sponsored option is better because they can go down to 600. Maybe you make too much money. You can do a lender-sponsored. Maybe you're not a first-time home buyer. You can do lender-sponsored again. It can be a better deal. But also, the thing that I really want to emphasize is a lot of these down payment assistance programs are just second liens. And the truth is, it says forgivable, but that's going to be finally at the end of year 15. How many of you, raise your hands, are going to be in the house that you're buying, the first house you buy, for 15 years? I would imagine no one's arm has gone up. How many of you are not going to refinance You're going to live in that house for 15 years, but you're not going to refinance for 15 years. You're not going to either find a better rate and refinance to save money. You're not going to need to pull equity out of the house to pay for X, Y, and Z. Again, nobody's hands raised. So this is a second mortgage that's not forgivable. It is forgivable, but don't think about it as forgivable. I want you to think strategically about these things. It's important to understand what it means, what it doesn't mean. So just because it says forgivable, functionally speaking, it's probably not going to be forgivable. It's not a bad thing. To buy my first house, I had to use one of these programs. I needed a second lien. And guess what? My home value grew over time. I was able to refinance, pay it off with the equity of the house. So I never really had to have that cash come out of my pocket. It allowed me to buy a house sooner than I would have been able to otherwise. And it's functionally just giving you 100% financing most of the time, right? It could be more than 100% financing. In my case, it was 101% because I had no money. But for most people, this is just effectively what a VA loan offers or a USDA loan offers without a second apparatus. So you could be an FHA, you need 3.5% down. We're going to give you a 3.5% grant to cover that. Cool. These come in two parts, one part, two parts, but fundamentally it's 100% financing. So people freak out about this. It's not that scary. That's all it is. It just comes in two parts. It's a good tool to get you in a house. So what I tell people is, if this is you and you need this help, come talk to somebody who knows what they're doing and help and ask them to give you advice. What should you do in your scenario? Everybody's scenario is different. You need expert, customized guidance to know what's best for you. Just know that these options are available. That's so you can buy a house. Closing costs. Let's talk about this because this is important. Many assume the down payment's all you need. You need 3% down on a $100,000 house. What is that? $3,000. $200,000 house, 3% down, $6,000. $300,000 house, $9,000. You think that's all I need? Nope. There are fees associated, what's called closing costs. So you have lender fees, third-party services, you have settlement fees, you have prepaid and escrow fees. This here is a closing disclosure, a snapshot, where it breaks down every fee. I took this from the CFPB website. So this is not a real one. This is not a real person. This is a fake person, but it is a real looking closing disclosure. This is what it would look like. If you pay any points, if you have an application fee, if you have an underwriting fee, those sort of things are going to be charges here. Services you cannot shop for, appraisal fee, credit report fee, tax monitoring fee, like all these things are standard that everybody has to charge. They're here. You have to pay for them. You have services you theoretically can shop for if you got a survey. It's optional, usually. Pest inspection, optional unless it's VA. Title stuff. You need an attorney to close, to actually have the paperwork to say, yes, you own the house, to sign it with you. You got to pay for those people to do their job. You also have the prepaids and escrow. So what that is homeowners insurance and taxes. If you're buying your first house, look, you're going to have to pay for that full 12 months of premium of your insurance up front. You're going to collect that full thing. In this case, it shows 6 months. This must be a refi, but you're going to pay 12 months there. And then they're going to collect an extra 2 months of that as a cushion, because as part of your mortgage payment, if it's escrowed, it's going to be principal and interest plus taxes plus insurance. They're going to take your annual taxes, your annual insurance divided by 12 and add that on your mortgage payment. You're going to make that payment every month. It's great. I love it. You should escrow, I think. Then they're going to collect a little cushion here, because the last thing they want is when it comes time to pay the annual premium, they're going to do it for you. Both taxes and insurance are going to do it for you. The last thing they want is to come in there and say, oh, we collected enough for $1,000 and now you're telling us the premium went up to $1,300. I'm $300 short. I'm going to have to go talk to Jordan and tell him I need $300 tomorrow. They don't want to do that to you. They want to have collected that extra money and have it in the account so that they can just pay it. So they create a cushion. If they have too much cushion, they will send you a check in the mail and say, here, we have too much money. Sorry. Not a big deal. So just keep in mind, it's down payment plus all these fees. You know, in this case, it was $18,000 down payment and $8,000, I think, of closing costs. Now, in our market right now in 2026, it's very normal and common to see sellers covering the closing costs. They're going to give you a credit of $8,000 to cover that. So then all you need is your down payment. That's awesome. Strategically, you need to work with an agent who's good at that, who understands that. And I will tell you this. I personally, especially if I'm buying a first house and I'm limited on cash, let's say it's $400,000 house. Let's say they got another offer for $400K as well. and my $400K offer was with $8,000 seller credit to cover closing costs. They're going to take the other person because it's $8,000 cheaper, right? They want to keep $8,000 in their pocket. I'd rather say, look, I'll pay you $408 and give me $8,000 closing costs. So effectively, my offer is the same. They're going to get the same amount of money. But now I just structured this deal in such a way that now you're paying for all of my closing costs. I'm basically able to finance them so that I don't have to pay them out of pocket. Strategy wins the day, okay? So the point is, there are fees that you need to know and be aware of. You're not going to go somewhere and not have these fees. You always have to have someone close for you. You have to pay for your insurance and your taxes. You have to pay for an appraisal. These are third parties. The lender is not affiliated with them. You got to pay for the tax, random stuff, the credit report, like credit bureaus set the price, not me, not a lender. So it's just everybody has to pay it. It is what it is, right? You have these closing costs. You have to pay them. Just be aware of that. That is part of this. There are ways to get around paying it. There are ways to finance it, but you have to be smart and understand how to do it. Now, pro tip, you want to have a loan estimate as soon as you can that's going to itemize all these things. Now, before a lender has an address, say like you're buying a house, if they don't have an address, they're not obligated to give you a loan estimate. But they should be able to give you an itemized fee worksheet that's going to break all that stuff down still. Now, a loan estimate is binding, and if they tell you it's this, it's got to be that. A loan fee worksheet, it doesn't have to be that. So there's some lack of transparency on the fee worksheet just because it's not committing them to those things. Now, an honest lender should never have any of those change, but just be aware of those things. So finally, 3 scenarios. Let's look at them. A $250,000 house purchase. You got a 780 FICO. It's a single family home. I'm doing this in North Carolina. We got a conventional USDA and then an FHA with 3.5% down plus a 5% grant. That's going to be a second lien. So let's look at what these all look like. Your down payment, $7,750, 0, $8,750. What's your rate in these scenarios? It's going to change, 6.125, 5.625, 7.25. So your monthly payment, $1,546, $1,527. USDA's got the lowest payment here. $1,785, that payment's a lot higher, right? Not a lot higher, but it's definitely higher. Your total payment then, $1,880, $1,860, $2,118. Because there's mortgage insurance on both of these, all 3 of these, right? So you got mortgage insurance, homeowners insurance, taxes on all of them. So your total payment's right there. Your total closing costs, $6,000, $9,000, $11,000. FHA is going to be the most expensive in closing costs. Conventional is going to be the cheapest. And then you have your total cash to close, like $13,000. So this is down payment plus closing costs. $13,000, $7,000, $3,000. What? FHA is the least out of pocket here in this scenario? Yes, it is, because that 5% grant. So depending on what you need, let's say you didn't get any closing costs covered by that seller. This can get you in the house for $3,000 out of pocket total. $3,000. USDA, $7,000, but you can get that seller to cover that $7,000. You're paying $0 out of pocket. I have it all the time. Seller covers it. They actually get a check back for the earnest money that they put down. They get a refund because they spent, there's an overage, right? So it's amazing. You can get in a house for very little money, but you also need to be aware of the difference between down payment and closing costs, because that's important to think through. So if you haven't, take some time to watch the other modules on this, to be a master, to know what to expect, how to strategize, how to think about buying your first house.